Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities. If you have any questions about the share or bond market, pick up the phone, call us 1300 30 34 35. The email yourmoney@skynews.com.au. And joining me on the panel tonight is Christopher Joy. Chris is a columnist with the Financial Review and he's a director at Yellow Brick Road Funds Management. And Liam Short, who is from Verante Financial Planning. Gentlemen, welcome. Yeah. You all well?
Yes, very well.
Tell me a little bit about Verante.
Basically, we're a financial planning and SMSF coaching firm out in northwest of Sydney, based in Castle Hill and Windsor.
Yep.
We tend to work with clients to basically look at the strategy and structure rather than the investment side of it.
Right.
If you get the strategy and structure right first, the investments will follow along.
I'm guessing there's a lot of work with training self-managed super funds at the moment.
Yeah, look, we really believe in the education side of building people's education up, because if you set a plan for them, educate them, they're more likely to stick with it and actually succeed in the plan. So we do blogs, we do boardroom sessions, one-on-one meetings.
Yep.
Just basically educating people up to the level where they're confident with what they're dealing with.
Mate, you've been writing some stuff about the SMS world and about how they're applying their investment thesis and the like. So I was looking at some stats in the Fin Review. They have 500 billion of investable dollars. There is 670 created every week. Clearly, it's a GFC response. People want control of their own destiny. That'd be a fair assumption. How do you think the education pathway is evolving? Do you think it's appropriate, or do you think it's, at this point in time, they're still relying on their stockbroker for everything?
I think folks can get really good advice from their financial advisors. I think stockbrokers are skilling up on asset allocation, and they're getting much more sophisticated in thinking about portfolio construction. And I think, interestingly, the platforms are also diving into asset allocation and making sure they get the balance in portfolios right. One of the interesting fixed income products you might want to talk about later is just the prominence of hybrids in that space.
Yeah, well, let's talk about that, because you remember that you wrote an article for Capital. It was a couple of weeks ago.
Right,
maybe might have been in the last 3 weeks. And I know you watch the show religiously, so you know that I've been advocating this article in Capital. So I actually got a lot of emails when I talked to people about it, and I sent them out. I thought that was a great, simple analysis on the lack of pricing of risk. So do you want to sort of talk about that? Can you talk about that in a shortened sense?
Yeah, I mean, that specific article was looking at the opportunities for banks to raise money cheaply through these things called hybrids, which are basically a mix between bonds and equities. They're not really, they're actually convertible preference shares. The income you get from a hybrid, most hybrids, is not interest. It's not a formal obligation of the bank. They can stop paying you that interest whenever they want. I think one of the fantastic things about the ASX market is we've seen an explosion in what they call interest rate securities. So on the ASX today, we have senior bonds, we have subordinated bonds, and now these new hybrids. The risk with hybrids in sort of short form is a lot of them have these things known as non-viability clauses or equity conversion clauses, and I think the concern is that in all the bad cases they convert into equity, so you bear the downside risk. In all the positive scenarios, you're stuck with debt and you get none of the capital gains.
Yeah, and then there's the Coco type scenario where you want to talk to the viewers about how you get nothing.
Yeah. So
the kick out.
This is a really interesting issue, which I've debated, I've got to say, with the banks privately and also with the regulators privately.
But
basically, what's happened is the regulators want the right in a stress scenario. The problem is they never tell you what a stress scenario is. So APRA is deliberately saying a stress scenario is whatever APRA defines as being stressed. What they can do is they can first convert you into equity, and if they can't convert you into equity, they can completely zero or write off 100% of the value of the investment. There are actually some securities that are being issued, some hybrids, where APRA can pull the write-off trigger at the first available stress opportunity. So in a sense, there's actually a case that these things in unusual circumstances, rank behind equity. So then the question is, why is my total return on a hybrid less than what
the equity?
Yeah, the shares. It doesn't make sense.
We have our first caller for the night, and it's Chris from Melbourne, and he wants to talk about the bond market collapsing. Chris, how can we help you?
Oh, yes. I was referring to this mainly because a lot of people are talking about the bloated share markets, but no one's talking about the bloated bond market in America. Might be a bit of a risk that's not being watched too carefully. I'm just wondering what sort of result that would have if there was like a mass exodus from the American bond market once tapering kicks in on the Australian hybrids and bonds, even the private ones, even the ones owned by banks and that.
So that's a great question, Chris. We're basically looking at what's the kick-on effect, what's the knock-on effect of the United States in the way the bond market gets belted out. Do you want to take the lead on that one first?
Yeah, just quickly, you've got to distinguish between floating rate or variable rate bonds and fixed rate bonds. Most of the ASX securities are variable rate. Through FIIG, you can buy over-the-counter lots of floating rate bonds, and those securities thrive, in theory, during these scenarios where we get increases in long-term interest rates that reduce the value of fixed-rate bonds. We've seen some of that, subject to the recent decision around tapering, but that's a kind of short.
Yeah, and so the short version, Chris, is if you have two aspects to think about, don't you? You have the interest rate piece, so where interest rates going, that'll affect something if you're fixed or if you're floating, and I suppose you've got three. You've got credit, will the person pay back their debt? So that's the next question. And then the last one is, I suppose, the inflation piece. What's inflation doing? Have I got an inflation bond? I've been calling it the Rumsfeld portfolio. So when you do your analysis with your customers, it's you don't know what you don't know. So
unknown unknowns.
Yeah, unknown unknowns. And I think that's an interesting idea that we've found that with the Fed governors, he doesn't really know what he's not that he doesn't know what he's doing, but he's been able to prove that he can't control it. And so that's the known unknowns. So thanks for the question. We have our first email for the night, and the email is from Betty. And I think this is one that you'll be able to delve into, because Betty's a retiree, and she says, everyone talks about the need to lower interest rates so that people have enough money to spend and thus businesses thrive. Why is nobody talking about the effect of lower interest rates on the buying power of retirees? If interest rates rose and retirees and those close to the retirement have more money in hand, and this will enable them to spend money on themselves and perhaps, Betty, on their children and grandchildren, it could lead to an economy that led by us older folk. What do you think, Betty? Liam?
Betty, I hear where you're coming from. Only about a third.
Is that because you're older?
Yeah.
Right.
No, I have a lot of clients in that area. Basically, a lot of people, only about 1/3 of mortgages.
Yep.
That means about 2/3 either don't have mortgages, or there's a lot of retirees relying on income. But unfortunately, Betty, a lot of people who are in that retiree market who could get behind you and form a voting bloc to actually make some noise about it, they're in well-diversified portfolios that made a lot of money on shares this year while interest rates went down.
Yeah.
I saw a client today who's in a fairly moderately conservative portfolio, about 40% shares in property, and they had an 18% return for the year. So the big problem is the people who are chasing the 3 and 6 month term deposit cycle. If you're constantly just renewing for 3 and 6 months, you're going to get caught in these bad times when interest rates go down. But it's not the time to switch across to equities.
Liam, when you talk to a customer who's got that sort of rally in their equity piece or rally in their portfolio at 18%, cash rates are at 2.5%, what are you suggesting? Bank some of the money, or
we're banking some of the money.
Yeah.
Basically, anything where we see it's overheated, we're pulling people back to the profiles and actually maybe underweighting certain sectors.
Yep.
But what I believe is in a situation like this, you're far better off at 3.8, 3.9% from a term deposit, and the ability to get into the market if something happens, than actually being in the market and being overexposed.
What do you think about Betty's scenario, the effect of the retiree dollar, the fact that they're not making as much money as they used to on term deposits, maybe not as comfortable going trading CBA and call options? What's your thoughts on that?
Yeah, I think Liam's point's really interesting, and I think it's a case study where you do need that asset class diversification because you're not getting the returns from cash. You are with equities and housing, which we can talk about later.
We are definitely talking about housing, because you guys are housing up the wazoo at the moment. It's the housing show.
But let me just say a couple of things. I think since the start of the year, I've said that I think this interest rate environment is going to be very favourable for so-called risk asset classes like equities and housing, and I think that's what's played out. As far as the RBA is concerned, however, the volume of money that is attributed to creditors, swamp savers. So that's why lower interest rates are net stimulatory for the economy. But it is it's a bit of a perfect storm for really conservative savers, because you've got low interest rates combined with a potential Armageddon facing fixed rate bonds, so they could suffer from both capital losses and this unacceptably low income. I'll just say that as Mark knows, I haven't agreed with several of the RBA rate cuts, so I'm one of the few advocates out there for the folks like Betty.
He has been pushing Betty's barrow for a long time. It's been pretty much by himself. He's been barrowless. We'll have to leave it there and go for a very quick break. We'll be right back. If you'd like to speak with our guest, please feel free to give us a call on 1300 30 34 35 or the email yourmoney@skynews.com.au. We'll be right back. Welcome back to the Bonds and Equities edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight is Christopher Joy, a columnist with the Financial Review, a director of Yellow Brick Road Funds Management, and Liam Short, who is from Verante Financial Planning, which is a business you own.
Yes.
Which is, congratulations on owning a business. They're here to answer any of your questions. Feel free to pick up the phone, 1300 30 34 35, the email yourmoney@skynews.com.au. I got it completely wrong. I said they'd taper in September. I had a couple of people I really respect who said that you're an idiot. They've reminded me of that. I thought it was all around the politics at the end of the day. I thought that they had to start at some stage. So what was your thoughts on the non-tapering?
I actually didn't think to taper very much. I thought it would start very, very small amounts.
Yeah.
But then people start saying 10 and 20 billion less in one go. That was always going to be too much. They'd already jawboned since May, advertising what they were going to do. So I was kind of unexpected, like everybody else.
And we talk about the tapering. We've talked about it a lot on the show because it's important, and people might get a bit bored about it. But what was your interpretation? Because I'm just going to keep talking about it. I don't care.
Yeah, I think that the Fed and Bernanke particularly probably got a bit of a jolt and a fright in June when they started sort of signalling that this was coming onto the radar screens pretty obviously. I mean, it's true by definition. You can't sort of continue buying private assets and government bonds and corporate bonds and equities in the case of the Swiss and Japanese central banks forever. But the market reaction across all asset classes was so violent that I think once again we've had a lesson here that policymakers cannot engineer global private market outcomes. I think the other important thing for me from the decision was potentially this is a portent that Yellen, who's obviously vice chairman of the Fed, is having a significant influence on outcomes because she's understood to be very, very growth orientated. She's not an inflation hawk. She's demonstrably dovish, in the words of Warwick McKibben, who used to sit on our RBA board and worked with Yellen, or has briefed her in the past. And I think this Fed is really focusing on reducing the jobless rate. We had that weak jobs data that came through, and at the margin that may have influenced the outcome on a month-to-month basis. And they're not worried about inflation. And I think, again, my investment takeaway from that is that the risk is that if Yellen is appointed, this will be an incrementally more dovish Fed, and that we could see some pretty serious imbalances in financial markets start to accumulate in the medium term.
But I'm not disagreeing with any of that. Getting back to my point about the politics of it all, Yellen's going to have to articulate, because what's happened in my mind is everyone's looked at the jawboning by Bernanke and turned around and said, you know what, I don't believe it. So Bernanke said he made a mistake when he spoke to the Republican end by saying, we'll consider it, in the September period. He made a mistake by then having a meeting saying, yes, we are going to consider. He saw how the market reacted, and he's trying to do this thing where he said, tapering and interest rates are different. I'm going to taper but keep interest rates low. And the market has just seen through that and just belted interest rates.
Yeah.
So now Bernanke's going to hand over to Yellen in the January. Let's say it's Yellen. Would have been fun if it was Summers. But let's say he hands over to Yellen. That's a hospital pass. Because she's going to have to articulate, as the Fed governor, this is what we're going to do. Now, we know that the jawboning doesn't work, so why would he do that?
A couple of comments. The first is that quantitative easing, this process whereby central banks print money because they have a monopoly right to print money, and then they go out and buy stuff to bid up its price and reduce its implied cost. This is unprecedented. So this is an experiment that has no antecedents. So I think that maybe there's some wisdom here that the again signals and portents we saw in June about the potentially highly destructive market reactions to the change in policy. Maybe their view was they want to go softly and really surprise the market positively with their accommodating posture. And again, this is an inevitability that has to happen eventually.
Do you feel that they're giving them too much? Do you think Chris is giving them a little bit too much credit? I mean, he does hang around and have coffee with them.
One of the things I feel is that they didn't make the move because they want to smooth their transition across to whoever replaces Bernanke. And I believe if they'd started the tapering and also did the transition at the same time, the market wouldn't have believed whatever they said. So they decided to be ultra cautious, change the goalposts a bit on the unemployment figures. So they're basically saying it's growth at any cost for America, and they don't care who's the collateral damage as far as Indonesia, Brazil, or.
Well, they don't care about that. If you ever met an American, they can't spell Indonesia.
What about us and our dollar?
Yeah, our dollar. They care about us. I mean, forget it. We're lockstep with Americans unless they don't want it.
Which actually creates interesting problems for the RBA because suddenly people are talking about cuts again.
Absolutely. What about the except for you? What about the reality is that they've been spending $85 billion consistently, and they've continued to buy, and they've sold through those interest rate bids. So they're saying, the Fed have said, I'm buying mortgages, everything, and they've said, thanks very much, I'll keep selling. Well, where's your next bid? And they keep hitting higher, and they've moved it in a massive way. I think people are losing sight of the fact that the Fed has continued to buy the $85 billion regardless while it's considering. Does that mean $85 billion isn't a big number?
I think 85 billion is a massive number. And I think there's been huge balance sheet expansion, and I think there's massive and again unprecedented government distortion of financial market prices. Which, again, what are the next steps here and the follow-on consequences? Nobody really knows.
When you combine the 85 billion from America with the economics, 85 billion in Japan, and I think Japan's probably even a worse case because this is sink or swim with them. But look, those figures go well above most people's heads.
Absolutely.
They just don't believe them.
Absolutely. But if we then come to the conclusion that they've continued to buy 85 billion, that the short sellers have sold through them, why hasn't there been a massive rally? Why hasn't there been a rally? We've caught the short guys, we're going to continue to buy 85 billion, and it hasn't happened. The markets have done nothing.
Yeah, I think because the markets again see the inevitable result here, which is that
just hold you short.
Tapering is tautologically by definition something that has to happen, and there's so much upside to interest rates. We see in Australia 3-year government bond yields in Australia. So the medium-term interest rate benchmark has increased from about 1.9% to, on some days, significantly over 3%. We've seen the 10-year yield rise from under 2.9%, I think, to over 4%. So
they're big numbers.
And the market's already anticipating, I think, tapering, and it's pricing it in, and that's a process that is more or less irreversible with that.
I need to talk to you. We have to take a call off David from Queensland. We'll be talking interest rates, I can tell you. Hello, David. How can we help you?
Oh, hi. Thank you for taking my call. Look, I've got a very tricky one for you here. My family has inherited some their Romanian bonds, and they're about the early 1900s.
Right.
And the relative of ours when he escaped Romania, he took the bonds with him, and he married into our family and that, and he's died in the 80s, I think. And we've had them for bloody 20, 30 years, and we don't know what to do with them. They're just something to look at. I don't know how to go about it. I don't even know if they're worth anything. But they're government bonds, and they're like really old. Any help you could give me or advice would be helpful. Thank you.
So this is a great question. Some beloved Ceausescu's KP has been able to bring out some paper. I think the idea is that we have some old bonds in our office, and they're framed, and they've got some value around the antique quality. I don't know what Ceausescu bonds would be worth, but
this isn't Ceausescu.
Isn't he the
This
Romanian?
is pre-Ceausescu.
Wow.
You said
Early 1900s.
Oh, wow.
He took the bonds. He obviously thought they were important. When he escaped the country, he took the bonds with him. And I'm pretty sure that he escaped after it became communist after World War II. But the bonds were from, they're over 100 years old.
Well, they've got to be worth something to somebody, I would have thought. So why don't you just send us an email? The email is yourmoney@skynews.com.au. I mean, I won't have an answer for you now. Chris,
I've got a quick comment, which is that if you don't understand them, we don't understand them. Get rid of them.
Yeah. No, don't get rid of them.
Wait. Subject to the writer that I would really sort of relentlessly, maniacally test pricing for those bonds, because to Mark's comment, there will be people that probably place a significant price on them.
Absolutely.
But I'm not personally a fan of holding stuff I don't understand.
No, that's right. So what I was going to say was, please send us an email with your contact details, and we'll just start the discovery, discovery channel business-wise, and we'll see if there's some value in them for you, and that would be a lot of fun. So we'd be very happy to help with that one. Let's talk about the US economy. So, because we're about to go into the interest rate narrative, which is interest rates are higher. Interest rates are higher in the United States in a meaningful manner. Mortgages have been quashed. They're just not. To some extent, we can see what our economy will look like if we lift interest rates. What's your thoughts on the US economy?
I think that the Fed's option is it must grow at any cost. So basically, they're going to do whatever they can to promote growth in the market. But because of the jawboning over the last 4 months, the mortgage rates had actually risen along with the 10-year bond rate. So you're looking at 4.6% on mortgages, which totally has deflated a lot of the surge in the property market over there.
Yeah, which is where they wanted. Bernanke saw that was the problem he had to try and fix, and we will be talking about that after this very short break. Please feel free to give us another call on 1300 30 34 35, and the email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to the show. If you have any questions on bond or equities or Romanian bonds, feel free to pick up the phone, 1300 30 34 35, and the email yourmoney@skynews.com.au. We are going to talk about the US. Do you have any clients that invest in the US? Is that something that you've got people coming to you and saying they'd like to do?
Look, especially with the SMSF clients, a lot of them who were self-directed didn't have any exposure overseas.
Right.
Suddenly the US dollar or the Australian dollar drops, and they see that there is a possibility to make some money out of it.
Yep.
A lot of them are dipping in with ETFs or using one of the larger funds that are well known, like Platinum or Magellan, even though Platinum underweights the US, but they're looking for some exposure to that. One, because the Aussie market they feel is very fairly valued at the moment.
Yep.
So they're looking for anywhere to put the money.
I mean, clearly Magellan's done so well, so everyone wants to be in the Magellan
But
fund.
it's a good story. You can see the products that they've got. You can see of each of the companies. Every 3 months they come out with a list of the top 10 holdings they've got and the brands that those holdings own.
Yeah.
And you talk about the story in China of opening up 16,000 KFCs, 800 Pizza Huts. People understand that as people are rising from working class to middle class, they're going to aspire to the same healthcare, the drugs, the bad things like the whiskies and the KFC, but people will need deodorants to work in offices. That's the Magellan stories. They're predicting what the middle class will need.
Yeah, so at YBR we've had US bonds. So we've issued here in Australia by US issuers, so Goldman Sachs, Morgan Stanley, Bank of America, GE.
So for the folks at home, we're talking US credit in Australian dollars, so that's the way we describe that.
Yeah, so they're known as kangaroo issues.
Kangaroos, yep.
Yeah, they've performed really, really well because they provided those investors with exposure to the US housing market, particularly through Bank of America, and also the recovery in the US investment banking business. We've had double-digit growth in US house prices. Obviously, it'll be interesting to see how they respond to the higher long-term rates.
Yeah. What about, I mean, I wanted to ask about the US gridlock. I mean, the way I see the gridlock is the fact that Bernanke looks to the legislative, looks to the Congress and said, I'd like you to get your house in order. And it was things like when they brought in all the taxes and the sequester and all that. And he said, don't do that. Please don't do that. And they went, who are you again? Remind me. And they just went and did it. Do you find it perplexing the way they conduct themselves at the moment. The fact that we're now going into this debt ceiling question on,
Again.
when is it, October the 1st? Don't you think that's a bit challenging?
I remember reading an article last year about Deepak Chopra, and he was saying that it was akin to an induced coma, whereby nothing was going to happen.
Yep.
And maybe that was probably the best thing that nothing was getting through at the moment. And maybe for the economy, that may be the best thing, that it gives the economy time to heal while these two sides just go to their extremes and just won't move.
Yeah, the only comments I'd make are, firstly, that the last time the US had a quasi-credit crisis, when they were downgraded and these sorts of issues arose, it was, I think, fascinating because bond prices actually increased.
Yeah.
Yields fell. Now, the alternative was that people regard the US financial system and the economy as riskier than they'd previously appreciated. You'd think that with this gridlock and the dysfunction and lowest common denominator politics, that there'd be a risk premium applied to US bonds. So perhaps that's something we might see as a result of this. But it is, I think, disappointing that politicians can't work together more productively. But then again, I guess we come to expect this.
By the nature, it's a dogma thing. Last week we had a guy called Craig Banning on, and he was discussing his clients were buying a lot of he described it as lower end property, and by that he meant it was just the 100s, the 200s, the 3s, the 4s, the 5s, up to about $1 million. What's your thoughts here on the property market? Are you seeing the same sort of thing?
Seeing a lot of people buying the quarter acre blocks in the outer suburbs or out in the country areas, regional areas, shoving on things like granny flats, for $100,000, and immediately getting $248 a week extra rent on something like that. So adding value to those lower cost blocks. So there does seem to be a big demand in that sector. I mentioned to you before the show, I saw 2 clients this week that both, who don't own their own houses, are perfectly happy to be renting in the suburbs they want to rent in, because they feel like they'll never be able to afford a house there, but they want to get in on the property market, and to do that they're looking at those outer suburbs and they're looking at the regional areas.
Let's talk. What do you think about that?
Listen, the housing market's going gangbusters, as we expected at the start of the year. I mean, Sydney house prices are up about 8.6% for 2013, which is a big number. So they're running at in excess of a 12% annualised rate. National house prices are up almost 6%, or 9% annualised rate. One of the points I want to make about that example that you nominated, it's interesting. Not many people realise that 95% of all home sales in Australia transact at under $1 million. So the $1 million plus market's sub 5% of all sales. And the median house price in Australia is only about $420,000. So if you're buying property, my advice is you want to focus on the mass market. So you want to focus on that sweet spot where there are the largest number of buyers, around the $400,000-$500,000 market, and you want to buy ideally detached homes that have renovation or usage rights. So the problem with an apartment is it's commoditised, it's very hard to vary. The great thing about a block of land, ideally in an urban area, is that somebody can come along, add a second story, or drop a pool in, and that provides an additional premium. But let me just say, I am concerned about the longer term dynamics.
Chris is concerned, and he's written an article that for the folks at home, you can get in tomorrow's weekend financial review at a very reasonable price of whatever that is. I think it's $3 or something. But feel free to read that article, because I thought it was a great article. I got it online. And I believe we might have some more callers. We're going to go to a break, I'm told. We're off to the break. We'll see you soon. Welcome back to the show. Joining me on the show is Christopher Joy, a columnist with the Financial Review and a director of Yellow Brick Road Funds Management, and Liam Short, who's from Verante Financial Planning. If you have any questions, please pick up the phone, call us on 1300 30 34 35, and the email is yourmoney@skynews.com.au. And we have David from Newcastle. David, how can we help you?
Hi, man. I'm just coming out of some fixed-term deposits, and I'm looking at buying some corporate bonds.
Yep.
Most of them are at fixed rate, and I think there's 2 that are floating. Is now a good time to buy them, or is it better to wait till I see what the U.S. does with their easing? Thank you.
Thank you, David, for your question. I think we need to get more information around what your goals are, of course, and if we make the assumption that you've got a balanced portfolio and we'll make some assumptions to make those decisions. I think the answer to the question is round about whether you should be fixed, floating, or both. Would you care to start off on?
Yeah, my view, very simply, is it's a terrible time to buy fixed rate bonds.
He said terrible there, David, and I'm going to argue against that, but that's fine.
A terrible time to buy fixed rate bonds. It's been more or less that way most of the year as interest rates have increased and holders of fixed rate bonds have suffered capital losses. And there's a lot of upside to future and particularly long-term interest rates. So I think if you want to be cautious and conservative, you would eliminate that risk by purchasing floating rate bonds. And then you don't carry that interest rate so-called duration risk.
Right. And so I would think, David, what I liked in the fixed rate space is the 2018, 2020 maturities, and I actually believe that the very cautious consumer will keep interest rates low for a long time. I think they're like tortoises at the moment, and they are not moving. There is some, and I'm happy to argue about the property piece making interest rates potentially move up, but I think what's happened is it's taken so long to move the dial 2.25% to these all-time lows, we're talking about going lower, that if you're picking up things that have a 2018, 2020 maturity in a fixed piece that's over 6%, you'll just run that down the duration curve, and so you'll pick up a pretty good return before we actually start seeing interest rates moving up. And I think the movement in interest rates going up will be very slow because of the conservative nature of the investors. The other point is that I think then Chris is right that you overlay it with a floating rate bond that is very long dated in its duration. So you've got a very nice spread above. So it could be an RMBS bond, it could be something like that, that would be 300 over the cash rate, and so you think over the longer term the cash rate will be higher, so you'll take some short-term cash flow issues compensating with some of your fixed. And the only other thing I'd ask is that you consider some of those inflation-linked bonds that go out to that 2030 period and say, look, I don't know when inflation kicks in, but in reality we've got 2 to 3% inflation, and you'll get some of these things at about 4.5 plus inflation, so you'll be getting a 7% return. And then the last thing you can say is, what are your expectations on your returns? If you can get 6%, will you be happy, David? Well, if that's where you'll be happy, then I think there's a lot of bonds around that'll cover that.
Yeah, I'd rather take the floating rate risk and put some inflation protection in place with the inflation-linked bond as well. I'd like to see more of those in the market.
Yep.
But the fixed rate at the moment, I read on The Wire that you were talking about the 6-year maturities offering about 1.5% extra over anything maturing in 2013-14. That's for people who've got a lot of knowledge, but for the average punter, they need to be very careful. Stay close.
Again, it comes down to, I suppose it comes down to, are you going to sell these things?
Yeah,
that's the key, right? If you were talking about the mark to market, to some people saying, what does that mean? Yeah. Well, that means if you're going to sell it, this is the loss you're going to take. But I'm not going to sell it. Okay, well then you're not going to take that loss. So I'm going to get 6%. And in the event that the consumer keeps interest rates low, your 6% 1 year, well, let me assure you, you'll be making some money on that puppy.
Yeah, and I think that's a really, really good point. My position would be very different, swing 180 degrees. If the caller said, I want to hold these to maturity, and then absolutely, if you're holding them to maturity, so 10 years, there's no problem buying some fixed rate debt.
So hopefully we've answered your question there. The other thing I wanted to ask you about was around that credit growth question. I mean, you were talking to me about people being able to borrow money because the parents come in and provide some support. Basel III is supposed to stop that, isn't it?
Well, I'm seeing more and more. I've seen more people come in this year and getting parental guarantees from my clients who are older, giving their kids them, than I've seen in the last 10 years. The banks are basically saying, yes, we're happy to lend the younger people the 80%, but then when they'll happily lend the other 20% based on the backing of a parental guarantee. That's getting around the rules.
Isn't that a worry?
I think with credit growth, what we're seeing is housing credit growth is running at about 4 to 5% per annum. It's actually running at above the weight of wages growth, which is around 3% per annum. But the problem with the credit growth numbers is they're looking at the change in the value of the home loans outstanding period to period, and because people are paying back their interest and principal payments based on old so-called amortization schedules or old interest rates, i.e. higher interest rate settings, repayments are actually speeding up, so the credit growth numbers are being artificially downward biased by
the fact they're paying off their loan.
The contraction in the stock of credit or the outstanding loans. And so we're not focusing on the flows. The flows are very, very healthy. We've got reasonable credit growth here in Australia.
I'll just segue to that. the opposite is happening in the States, isn't it? The duration is extending because people aren't paying off their loans.
Exactly.
Because the interest rates are going up. And to some extent, I go back to my same thing about the consumer. You can see that if interest rates go up, consumers just say, hang on, this hurts. And you can see the effect it has on the banks. Their portfolio of loans become quite stressed. And particularly in the States, so that's where I have to start playing around
And I
that
think
market.
the concern now is we have mortgage rates at their lowest level in recorded history. We've got house prices nationally running at 3 times the rate of wages growth. And the problem is that the housing market right now is priced to perfection. So there isn't a bubble. The demand and supply side fundamentals are really robust and healthy.
Yep.
But if we get double-digit house price appreciation, if prices continue to significantly outpace purchasing power and incomes, then we will have a problem 12 to 24 months down the track.
I mean, these are research notes that I was sent today, and it says things like Sydney auction levels at levels of not seen for a decade. It's cheaper to buy than rent. Property prices are going to go up. It's just because the cost of credit's so cheap. There's just this.
That's all right.
I'm not saying they're lies.
Yeah.
I'm just saying that there's this swell, this underlying swell that's taking through the market.
The RBA has engineered this situation because it's cut the cash rate to 2.5%. Savings rates don't provide adequate returns, so folks don't really have any other choices other than asset classes like equities. And the problem with equities, it has a very important role to play in a lot of portfolios. But the problem is that a lot of consumers have brain damage from the volatility in the equity markets.
Yeah, and I can get that too, because it's too volatile, and also the broker's saying, buy it now. Please buy it now, because do you want to see photos of my kids? Look, we've got a chart that Liam's brought in, and it's about the national house price growth and the credit growth. So we're going to try and bring that chart up, and we're just going to try and show how that plays out. Do you want to walk us through this, Liam?
The main thing I was looking at the graph on the right hand side was just seeing that that blue line is investor purchase of property.
Yep.
The red line is home buyers, and the yellow line is the average.
The middle line.
You can see in the last year the growth has been significantly in the investor section.
Yeah.
And that's where I'm saying that the banks are cherry picking. They're not lending to small business, they're not lending to first home buyers, they're lending to investors and to people who can provide those parental guarantees.
Chris, would you care to comment?
Yeah, I mean, the point on the banks not lending to business, there's a very good reason for that. And this is slightly complicated, but the short characterisation is that the regulator forces banks to hold much more capital against business loans than they do against residential loans, which means the returns and the profits the banks make on residential loans are much higher. So, of course, they're piling into the housing market.
There's your Basel 3 response. We will take a very short break. We'll be straight back. And please, if you feel like giving us a call, 1300 30 34 35. We'll be right back in a moment. Welcome back to the Bonds and Equities edition of Your Money, Your Call. We're still taking some phone calls. The number is 1300 30 34 35, and the email yourmoney@skynews.com.au. And we have an email from Mark, and Mark writes, "Hi Mark, who was right? Labor saying low interest rates are a sign of a good economy, and the coalition who said it was a sign of distress." Would you care to respond?
Yeah, sure. I mean, my simple response is neither was right.
Neither was right?
In abstract, low interest rates are never normally a sign of a good economy. It's normally a sign that we're experiencing a recession or very, very low growth, and there's a high jobless rate. So the RBA is cutting rates to stimulate growth. But I don't think we really had a deeply distressed economy either. I think you were saying in the break, Mark, that this was actually a function of overseas circumstances and our very, very high, lofty Aussie dollar.
That Aussie is just extraordinary.
Yeah.
You can see these charts, and you can see the currency not moving at all, and they kept cutting rates. And I think the policymakers were saying, hang on, let me get back. What we do, we cut, Aussie drops. We cut, and nothing happened. And so that would have been great for people, your clients might be going overseas. Happy days. But the rest of the economy is just getting crushed, and they're just trying to get it down. So how would you think the policymakers be feeling right now?
It's a very difficult job to do, and I think they're also learning from previous cases where everything went on the extremes. They overshot on the downside, they overshot on the upside, so they're trying to be proactive, and everyone's been talking down the Aussie economy, and we've done fairly well over the last 10 years.
Yeah. Don't tell the coalition
you can't tell the man in the street that, because they feel like we're going into a recession. I've got clients who just stopped spending money.
It's just a mantra. It's the marketing edition worked really well, so people thought the economy was a mess, and it wasn't really a mess.
Yeah.
I mean, maybe there's problems in the economy that we could say, okay, that we have structural issues. You know, you've got the Barnett government saying there's not enough tax. I get all that, but in answering Mark's question, yeah, you're right. Both were wrong. We were probably just trading, chasing the rest of the world.
The only other point I'd add is it is very, very tough for policymakers to get this stuff right. I think you've seen an evolution in the RBA's communications, because every move towards talking down the Aussie dollar and lowering rates, as you said, wasn't making much of a dent. And then suddenly we had this big shift in the valuation of the currency. One of the problems the RBA faces is their own research shows they can't forecast the inflation rate, the jobless rate, or the growth rate beyond 12 months. They have no idea what's going on, which actually tells you that they have no idea where interest rates will be in 12 months' time.
But Chris, with that in mind, and that's a really good point, when you hear Treasury gets it wrong about the budget and 3 months later there's a recalibration and everyone gets so angry.
There's an easy solution to all of this.
What, don't publish, or?
No, you got to publish. The technical term is the standard errors, but what you've got to show is the dispersion or the uncertainty associated with your base case forecast. And it's just madness that when we have these budget forecasts, they don't show basically all the downside scenarios and all the upside scenarios and place equal emphasis on those. And then folks would get an appreciation for how rubbery the forecasts are. And when they don't ultimately conform with reality, there won't be any surprises. And I actually think, to Joe Hockey's credit, he's planning on doing exactly that.
Really? Why do you think that?
Because he's told me.
Did Joe tell you that he would issue longer dated bonds?
I've heard him talk about it in the past, and I think that's probably on the agenda.
Yeah, in March he talked about specific government-backed bonds in the infrastructure in the private sector. So the government would back private companies.
Is that new debt?
But they would also issue 30-year bonds, government bonds, so that they could benchmark those. There would be a benchmark in the market for those company bonds.
It will be new debt.
That'll be new debt.
By definition.
And so the Labor parliamentarians will go to town on that, and we'll have that, as what the guy that runs the NAB was saying, we'll have a non-adult conversation about debt. We just don't have enough of it, and he was right.
Well, we've had it for the best part of 5 or 6, 7 years.
Yeah, and I think the idea is that, he was making a great point. If debt is cheap, borrow as much as you can, build the infrastructure. It's clear we need the infrastructure. It's the place is crying out for it.
And my clients will buy it. We're looking for long-term, steady sources of income, and clients are desperate to get it. So if they bring out something like that, people will buy.
And when you think about the way they're talking about the corporate bond market, that's a classic. You'd get it. And I'm not talking about the cross-city toll. I'm talking about proper infrastructure that isn't trying to get the eastern suburbs over to wherever they want to swim. It's more about what is the natural infrastructure between communities that is so relevant, so needed.
Yeah, my only observation on that would be that the challenge with infrastructure, and we have a huge, profound infrastructure deficit. I think most people agree with that today. The challenge is not funding it through debt. The debt's actually relatively easy to raise. The challenge is raising the equity or the first loss piece. The guys that got smoked on Lane Cove Tunnel, Cross City Tunnel. And my idea that I've put to the parties in the past have been to make the infrastructure equity investments a completely tax-exempt asset class, because frankly the industry funds and the super funds that do have the balls to invest in the infrastructure have a very strong preference, given the problems they had with their infrastructure investments in the GFC and the MTAAs of the world. They have a strong preference for the debt, and that creates a shortfall in the equity.
And you can imagine that if you said to them, okay, Sydney Airport, number 2, we're going to who will take the equity? I'm going to play around with the tax. You'd have a lot of people line up for that one, because obviously that's going to be a great a winner for a lot of people if they can get it right.
But the problem is we've seen so many of these projects where it's only the third time around that they become profitable for the equity holders.
Yeah, that's right. I mean, as you have clearly pointed out, Liam, it's better to be in debt than equity. So I thank you for that. We will go to another very short break. We'll be right back for the last segment for the night. Welcome back to the show. It's the last segment for the night, so we'll get straight back into it. We have a caller, Kerry from Carnegie in Victoria, on the housing market. How can we help you, Kerry?
Yeah, 2 questions. QE Infinity, and if someone can explain to me why can't the housing market in Australia crash like it crashed overseas in Europe, in America. I've just come back from the States, and I've been living there for about 6 years, so I saw the housing disaster in America, and some values came off 30, 40 and 50%. Now, a lot of commentators are pretty disappointed with the Fed not tapering off, so I'm more interested in with your listeners, with your guests, in talking about the housing market. Why can't the housing market crash in Australia like it did in America?
Sure. Okay. Would you like to start with why the housing market?
Sure, and I just plug, I've got a piece on afr.com.au right now. You can read it for free on whether we have a housing bubble or not, and that has all my analysis. But what I'll say quickly...
And it is a great article there, Kerry, so you can either go and buy it or get online.
Thanks very much, Mark. So I was rolled out by pretty much every bank in Australia during the GFC in 2008 and 2011. I presented overseas and here on why the Aussie housing market wouldn't blow up. And there are very, very good reasons as to why it's a high integrity market. I think the housing market will continue to run for as low as rates remain low. And if Mark's right about long-term rates, then it's going to be a pretty good trade. But I think your intuition is actually correct. I think there is every possibility that if rates do normalise and we get mortgage rates back to where they were in 2007 and 2008, so we're talking about 8-9 percentage points in absolute terms, we could see a very significant fall in Australian house prices, in the order of 10-20%, which would be the largest fall in history. And it only has to occur through a change in consumer expectations. So if bidders turn around and see falling house prices and they think their expected returns are going to be much, much lower, you can have quite a quick price adjustment.
I agree, but the problem, and my thoughts on it, Kerry, is the fact that it's the home ownership levels at the moment which are at record highs, and it goes back to the same theme about the consumer. The consumer themselves are incredibly conservative because of the GFC, because of what you've said. They've seen it from afar. They know how chronic it is. It's an equivalent depression in Europe. It's a disaster. And so what are people doing with these lower rates? They've been paying off more and more of their debt. So we're seeing greater house ownership, and so they can absorb. It's this mark-to-market issue. If my house goes down in value, it's just what my wife can't spend. We aren't using the house as the ATM like we used to. Everyone is much more conservative. There's not the flat screens, and that's what drove the American problem. They believed so much in the value going up. Used it as an ATM and therefore created the problem.
And they're not building houses just for the sake of building houses. In the last 12 months I've been to Ireland, Spain and Dubai, and you go through whole developments where houses were built on speculation.
I worked in the States for 3 years in the middle of this. I'd go to Arizona and they'd point over the hill and they'd say, over there they don't have water. I said, what is over there? And they said, that's a housing. And I said, what do you mean they don't have water? Well, the water board won't take water to them. They won't guarantee them water because we don't have enough water in Arizona. Why are they building?
I'll just also add, on the safety side and the security side, there are about 4 to 5 million mortgages in Australia that are outstanding, and of those mortgages, only about 30,000 people, which is a tiny number, about 0.6%, are behind in their repayments. So the default rates in Australia, right through the GFC, were about 1/10 US default rates and a fraction of UK, Spanish and Irish default rates. So we have a very, very good track record. In the 91 recession, interestingly, when interest rates were back at double-digit levels, overall national house prices only fell 1 or 2%. Having said that, I think we're in a new environment. Household leverage is multiples what it was back in 1991, and consumers are much more interest rate elastic or sensitive.
Yeah, and I just think it comes back, you're right, I get all that. I just think it comes back to how that consumer behaves. And if the consumer starts to believe...
Yeah, if you're right, housing's a great bet.
They're super bulletproof, then, I just can't see them doing that at the moment.
Yeah.
But look, everything's fine. At the moment the banks are stress testing every new mortgage 1.5% or 2% above. But we're at, 4.9% or 4.5% in some mortgages. As Chris said, we could be looking at 8-9% in 4 or 5 years' time. That's when it'll really hit home.
You just mentioned something that really worries me. It's not good enough to stress test your home loan. And I say this to everyone who's watching tonight. Don't assume that you have to pay 1.5 or 2% more than what you're currently paying, which is about 5%.
Yep.
You should be assuming that you're making repayments at interest rates that are 3 or 4% higher than current levels, because current mortgage rates are the lowest they've ever been in the last 60 years of recorded data. So we're in an extremely unusual period.
And so bank it. So bank it when you've got it. Don't go and spend it on it. There's no point buying the new car and the flat screen. Bank the money and let the RBA work out how to get us forward. what stimulus.
And
what
lock
tickling.
in some of your risk now. Lock in some of the fixed rates.
Oh, absolutely. I mean, I completely agree with that. I mean, fixed rate home loans, I locked in mine for 5 years.
I just did it yesterday as well.
Yeah.
Everyone's locking in their fixed rate loans. That's pretty good. That you also buy fixed rate bonds. That's pretty good as well. That's all we have time for today. One thing I want to do comment. Last week I said about the capital structure. A viewer wrote in and said the people who are secured creditors get paid out first. Clearly that was wrong. That's the joy of live TV. You have to think on your feet, and I'm not that good at that. So thanks very much to our guests, Christopher Joy, the columnist from the Financial Review and a director of Yellow Brick Road Funds Management, and Liam Short from Verante Financial Planning. And to you, the viewers, for your emails and your calls, it's been great. Until next time, I'm Mark Todd, FIIG Securities. Have a great Friday night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions,